Hello, money and history viewers. Hope you're doing well. Today's topic is about a big truth that we all think we know, but most of us actually don't. The money in our bank accounts has a story very different than it appears. In short, friends, here's how it goes. The money in your account isn't really there in a literal sense. This isn't a metaphor or a conspiracy. If everyone went to the bank tomorrow to withdraw their money, the system would collapse within hours, because that money doesn't actually exist in the vault, and this isn't some flaw added later. The system was intentionally built this way. Like a centuries-old game, this system is called fractional reserve banking. It's the silent engine that keeps debt, inflation, and the illusion of wealth running. When you grasp the truth, you see that money is built on promises that can never fully be redeemed. To understand where it began, we have to go back to long before we lived with numbers on a phone screen. In medieval Europe, money was gold and silver. Those who had wealth stored it and traded it. But hauling around bags of gold was dangerous. Eventually, people began storing their valuables with goldsmiths who had secure vaults. The goldsmith gave them a receipt which could be exchanged later for their gold. Soon people realized that the receipt worked just as well as the gold itself. It was lighter, easier to carry. That's when the magic started. Goldsmiths noticed that people didn't all demand their gold at the same time. Out of 100 customers, maybe 1 or 2 would show up. The rest of the gold stayed untouched in the vault. So the goldsmiths thought, since no one's coming for their gold, I can issue more receipts than the gold I actually have. And they did. If they had 1,000 gold coins, they issued 2,000 receipts and lent out the extra ones with interest. They began profiting from gold that didn't exist. The modern banking system was born right here. Later, banks emerged and institutionalized the method. In the 17th century, governments adopted it too. When the Bank of England was founded in 1694, its purpose wasn't to serve the people. It was to finance the government's war debts. The state borrowed more than it had, and promised to repay the bank with interest. The money ultimately came from the taxes paid by ordinary people. What governments do today is the same: borrow money that doesn't exist and repay it with the taxes of future generations. It wasn't different in the U.S. Early banknotes were backed by gold, but banks quickly realized they could print more notes than they had gold. Panic set in occasionally. People rushed to banks demanding their money. But the cash wasn't there. Banks collapsed overnight. Instead of fixing the system, it was reinforced. Governments activated central banks to maintain the illusion, sending the message, "Don't worry, the money exists." Today it's not easy to understand how banking really works, but the truth is simple. When you deposit $100 in a bank, it's not sitting untouched inside a vault. In the past, banks had to keep a portion of deposits, say 10%, meaning $10 in reserve, $90 loaned out. That $90 gets deposited at another bank and loaned out again. By circulating like this, $100 becomes almost $1,000 in the economy. But remember, only a small portion of this is actual cash. The rest is debt. And here's something surprising. Reserve requirements in the United States are now 0. Banks are not required to hold even a single dollar against deposits. So what limits lending today? The brakes aren't reserves anymore. They are capital and liquidity rules, known as Basel regulations, created by central bankers meeting in Basel, Switzerland. If banks want to issue risky loans, they must hold certain capital. They must also maintain liquid assets like cash or government bonds. The system now depends on rules, not deposits. The critical point is this: banks don't need deposits to lend money. Loans are created first, and when the loan amount is credited to an account, deposits appear. Most money is created from nothing the moment it is borrowed. That's why more than 90% of money in circulation isn't central bank money, it's bank money, created when loans are issued. This system produces three major consequences. Inflation, because multiplying money through credit reduces the value of each dollar. Permanent debt, since money enters the system as debt, and interest increases that debt. It's impossible for the debt to be completely repaid. Concentration of power. Banks earn interest on money they never had. Governments borrow without printing money, and wealthy individuals benefit because their asset prices rise. When there's a malfunction, the illusion collapses. The Great Depression and the 2008 crisis are examples. When confidence is shaken, the system trembles. Governments and central banks print trillions to keep the system alive. Today, some countries still require reserves: China, India, Brazil. But they too follow Basel rules. Wherever you are, money creation is constrained not by deposits, but by regulations. The truth is, if everyone erased their debts, the system would collapse. The money supply is tied to debt. No debt means no money. So the system needs you to borrow. Protecting your money isn't about saving. It's about stepping outside the debt cycle, because the numbers in your account aren't real assets. History reminds us the system depends not on gold or production, but on trust. When trust breaks, everything collapses. So when you look at your bank balance, remember that most of what you see is just numbers, born from a system of debt. Once you understand it, you can protect yourself. Ignore it, and the game continues, and the house always wins. If this perspective taught you something new, stay tuned. History hides the answers, and I'll keep revealing them to you.